Let's understand the next part of the financial statement, that is an income statement, or what we call the profit and loss account. As I said, in the balance sheet is made as on date, but the profit and loss account or an income statement is for a period. So balance sheet is just a snapshot. It is about financial position, but the profit and loss account or income statement is about financial performance. It shows the profitability, the results, the outcome of the business transaction. So what we do in a business transaction, we purchase something and then we sell that, or we provide some services, or what we do, we purchase something, we do some processing on it, we process that raw material and then sell that processed material. So in terms of finance, when we purchase we have to pay, and when we sell we get some money. So the difference of what we pay and what we get is our profit, is the what the business earns. So suppose I purchased the raw material of rupees 100 and I sold it in rupees 150. So the 50 rupees is my profit. And let's take another example. If I purchased a material of rupees 100 and I did processing on it, and that processing cost me something, then I sold it in the rupees 150. So in that case, my profit is not rupees 50 because I have incurred some additional cost to process that material. So my purchase price is rupees 100. I suppose I have incurred a cost of rupees 20 to process that material and I sold it in the 150. So my profit is now remain 30 rupees because I have incurred some additional expenses to process that material. So if I summarize whatever I have explained right now, so in a business transaction, I have purchase, I have sales, and I have expenses that is directly related to the production of that material for processing of the material, and I have some other expenses also. So that expenses that are directly linked to the production or that are directly linked to convert that goods into the finished goods in order to sell them are called the direct expenses, and all the other expenses that are not directly linked to the production or processing, that are called the indirect expenses. So the component of the profit and loss account or the income statements are sales, or what we call the revenue, the purchase, what we call the cost, and other two components are direct expenses and indirect expenses. And in the result of that, we will get the net profit or net loss. As we are doing business for to earn something, to earn the profit, so our objective is to maximize our profit. So what we do, we purchase at the lower cost and we sell at the higher price. So the difference is our profit. So sales minus purchase is our profit, but that is not the net profit, that's the gross profit. So if we understand the equation, the sales minus purchase cost minus direct cost minus indirect cost is come to the net profit. There are some more terms in the profit and loss account or income statement, that is cost of goods sold, the direct part, the components of the direct expenses, and the indirect expenses, the depreciation, the tax, that we will discuss in the later video. As I already told you, now we call it as an income statement. Earlier we used to call it the profit and loss account, that is made into the T format, but now we made the income statement in this format. So in both the format, I'll explain with an example in the later part of this video.